Okay, let's unpack this. It is Tuesday, February 17th, 2026.
Great.
And if you were scrolling the business headlines this morning, you probably flew right past a name that usually defines flying under the radar. Genuine Parts Company, GPC.
The kings of the background, for sure. I mean, if you drive a car or walk into a factory, you've definitely interacted with them.
Even if you didn't know it. And, normally if I said we're going to spend 15 minutes talking about industrial replacement parts,
You probably lose half the audience right there.
exactly, you'd be checking your phone. But today is different. This quiet company actually dropped a bombshell. It's a massive end-of-an-era story.
It really is. We're talking nearly 100 years, a century,
Yeah.
of keeping everything under one roof. And now they're calling it quits.
Or at least filing for divorce. That's the headline. Genuine Parts Company is breaking up.
Yep.
They're splitting into two independent, publicly traded companies. It is the ultimate, it's not you, it's me conversation, but for billions of dollars.
And honestly, you have to wonder if it's about time.
Yeah.
But it's not just the breakup itself that's so fascinating. It's the how and the why.
Exactly. So for this deep dive, we're looking at the whole picture. We've got the separation plan, the Q4 2025 earnings report, which is, spoiler alert, an absolute mess.
Oh, it is.
And the transcript from the call with CEO Will Stengel. So our mission is to figure out why a legacy company splits up now, dissect the crime scene of this financial quarter, and see if the sum of these parts is actually worth more than the whole.
It's a detective story, really. We have a body, the Q4 earnings, and we have a motive, the split. We just need to connect them.
Okay, let's start with the motive then, the big split.
Yep.
They're aiming for Q1 2027 to split this beast in two. What are the two new creatures emerging?
So on one side, you get the business everyone recognizes. They're calling it Global Automotive.
NAPA.
That's it. This is NAPA.
The blue and yellow sign, the hat my dad owns.
Exactly. The distribution juggernaut, it's all about getting brake pads and oil filters to mechanics and garages. It's a huge business, about $15 billion in revenue. But then, on the other side, you have the business that I think is the real reason for all this, Global Industrial, which operates under the brand Motion.
Okay, now this is where I think people get confused. They hear industrial parts and they think, okay, NAPA sells car parts and Motion sells, what, big truck parts?
That's the misconception, and that's exactly why the stock has probably been held back for years. Motion isn't just bigger wrenches. This is a high-tech play.
High-tech how?
We're talking fluid power, pneumatics, and increasingly complex robotics and automation systems for factories.
So it's not a hardware store for factories?
No, not at all. It's an infrastructure company.
There it
I
is.
mean, think about the big trends driving the economy right now. You got reshoring.
Companies bringing manufacturing back to the U.S.
Right, to avoid supply messes. And then you have the huge build-out of data centers for AI.
Wait, are you telling me the auto parts company is secretly an AI infrastructure play?
In a roundabout way, yes. I mean, data centers need massive cooling systems, backup power. Motion supplies the guts for all of that. Factories need robots. They supply those too.
So it's like a couple where one person wants to restore classic cars in the garage,
Yeah.
and the other wants to build a high-tech robot lab in the basement.
That is a perfect analogy. Actually, it's great. They have totally different hobbies and, more importantly, different financial needs. The automotive side, NAPA, is fighting a war for the do-it-for-me customer.
The mechanics?
The mechanics. They need to buy more stores, modernize their software. It's a capital-intensive grind.
And the robot lab.
Motion needs to buy up small engineering firms. They need to acquire technical talent. They have completely different investment profiles.
So when they're together, they're fighting over the same allowance?
It's exactly. Management calls it capital allocation strategy, but yeah, it's about who gets the money. By splitting, Global Automotive can be a cash flow machine, and Global Industrial can chase that high-tech growth without asking permission.
And you get rid of that conglomerate discount.
Right. An investor who wants a tech stock doesn't want to be weighed down by retail auto parts, and vice versa. The split lets the market price them for what they actually are.
Okay, the logic holds up. Focus. But before we get to 2027 and these two shiny new companies, we have to wade through the swamp of today because they also dropped their Q4 2025 earnings. And looking at these numbers, yikes.
It was a chaotic quarter. If you just look at the headlines without any context, you would assume the business was just falling off a cliff.
Okay, so let's look at the damage. Revenue was $6.01 billion. That's up about 4.1% year over year, which sounds okay.
It's fine. It missed expectations, but it's not a disaster. It shows growth.
But then you get to the bottom line, earnings per share, EPS. Wall Street was looking for, what, $1.79?
and GPC delivered $1.55.
That's a big miss.
It is. But, and this is where you have to put on your forensic accountant hat, this was a classic kitchen sink quarter.
A kitchen sink quarter. I love that. Unpack that for us.
It's a strategy. Companies use it when they're about to do a big transition. They figure, hey, we're already announcing the split. Why not take all our bad news, all our write-offs, and just dump them into this one quarter?
So you make one quarter look absolutely terrible.
Awful.
So that all the future quarters look pristine by comparison. You're clearing the decks.
Exactly. And GPC cleared the decks to the tune of $1.1 billion in pre-tax adjustments.
$1.1 billion. That's a staggering amount of money to write off. What on earth did they throw in the sink?
Three main things. The biggest chunk. First, a $742 million charge to terminate their U.S. pension plan.
Okay, so they're just canceling the pension. That sounds harsh.
It's not a cancellation, it's a settlement. They are buying their way out of the obligation. Running one of those old-school pension plans is a huge liability on your balance sheet.
Like an anchor.
It is. So this hurts earnings on paper today, but it makes the balance sheets of the two new companies much, much cleaner. It's just good hygiene.
Okay, that's the accounting one. But the second one, this sounds like a real crisis. A $150 million loss related to a company called First Brands Group.
This the drama of the quarter. First Brands isn't some small shop. They make Trico wipers, frame filters.
Names everyone knows.
Exactly. Well, it turns out First Brands went bankrupt.
Oh, wow.
And GPC was owed a lot of money, rebates, receivables. When a supplier goes under like that, the money just vanishes. But the money isn't even the scariest part.
It's the parts, right? If your filter supplier goes bust, you don't have filters.
Imagine being the logistics manager at NAPA in Q4.
Yeah.
Your massive supplier just goes dark, and you have thousands of garages expecting deliveries. The CEO said they had to execute contingency plans to switch suppliers on a dime.
That sounds incredibly stressful, a total scramble.
It's a supply chain heart attack. They claim they pulled it off without any real disruption to customers, which is, frankly, a miracle of logistics, but it definitely hit the bottom line.
Okay, and the third item in the sink.
Asbestos.
Asbestos. In 2026.
The ghost of industry past. They had to increase their reserves by another $103 million. These are for legacy claims on products sold decades ago.
So the logic is, we're splitting up, let's pay off the pension, write off the bankrupt supplier, and fund the lawsuit account so the two new companies can start totally fresh.
That is the argument. Management is telling investors, look, ignore the $1.55. If you strip all this stuff out, we're actually doing okay.
Okay, is a subjective word, though. Because even if you strip out the noise, the actual business performance seemed complicated.
Complicated is the right word. You really saw a tale of two businesses, which just reinforces why they need to split.
Let's start with the star people, the industrial side. Motion.
Motion really did shine. Sales were up 4.6%. And what's impressive isn't just the number, it's the environment they did it in.
The manufacturing economy wasn't exactly booming in 2025.
It was terrible. The PMI, the manufacturing index, was below 50 for most of the year, which means contraction. Factories were shrinking, they were buying less stuff.
So the tide was going out, but Motion was swimming forward.
They grew sales in 9 out of their 14 end markets. We're talking food products, iron and steel, fabricated metals. This really validates that high-tech pivot we talked about.
How so?
Because even if a factory isn't expanding, they still need to automate to save costs. They still need to maintain their robots. Motion has positioned itself as essential, not discretionary.
That's a powerful story for the spin-off. We grow even when the economy shrinks.
Okay, now let's talk about the other sibling, NAPA.
A bit of a mixed bag here.
North American sales were up, but just slightly, right? 2.4%.
Yes, but you have to peel back the onion on that one. There's a sharp divergence happening inside NAPA. You have the company-owned stores, the ones GPC runs. Their sales jumped 4 to 6%. Doing great. Okay, so if the corporate stores are up 6%, but the total is only up 2%, who's dragging them down?
The independent owners, the local franchise owners. Their sales were flat to negative.
That is a stark difference. Why?
It's the macro environment. The independent owners are small business people. They're feeling the pinch of high interest rates way more acutely.
Because inventory costs money to hold.
Exactly. If you have to borrow at 8% to stock alternators, you're going to be really cautious. They are destocking, keeping inventory super lean. GPC Corporate has the balance sheet to keep shelves stuffed so they get the sales.
It really shows how this environment punishes Main Street more than Wall Street.
It does. And since so much of NAPA's network is independent, it just drags the whole segment down.
And then there's Europe.
The weak link. Sales in Europe were down 2%. They called out the UK, France, and Germany specifically.
A big three.
The economy there is just soft. GPC is in full turnaround mode, closing locations, consolidating distribution. It's not a growth story over there right now. It's a stop the bleeding story.
So let's zoom out. You've got a booming industrial side, a U.S. auto side that's steady but dealing with stressed out franchisees, and a struggling European arm.
And in the middle of all that, they're planning a massive breakup. It really feels like they're tidying the house before putting the for sale sign on the lawn.
And despite the Q4 mess, their outlook for 2026 is actually pretty optimistic.
It is. They're guiding to adjusted EPS of $7.50 to $8. That's solid growth. And they expect sales growth of 3 to 5.5%.
And for the dividend lovers out there, because a lot of people own GPC for that quarterly check, what's the news?
This is a key statistic, probably the most important one. The board approved a 3.2% dividend increase. This marks the 70th consecutive year of increases.
70 years. That is mind-blowing. That goes back to Eisenhower.
It does, and it signals huge confidence. You don't raise the dividend for the 70th time if you think the business is about to implode. It's a message to the market. Yes, it's messy, but the cash machine still works.
They also mentioned transformation plans. Is that just corporate buzzwords?
Seems to be some real meat there. They're projecting $100 to $125 million in benefits this year from modernizing their supply chain and IT systems.
Unsexy work, but profitable.
Exactly. But they dropped one other little nugget of hope. Something about January?
Yes, the January effect.
They noted that in January 2026, just last month, that PMI index we talked about finally popped back above 50.
So manufacturing is expanding again?
For the first time in nearly a year. If that holds, that is a massive tailwind for the industrial business right as they get ready to spin it off.
Yeah, that would be some lucky timing. Okay, so let's synthesize this. We have a historic split, a kitchen sink quarter, a hopeful outlook. Why should the listener really care? I mean, unless you own the stock, why does the GPC split matter?
It matters because it's a perfect case study in unlocking value. For years, GPC was seen as this boring, slow conglomerate. The high-tech, high-growth potential of the industrial business was just hidden behind the giant automotive business.
It was hiding in plain sight.
Exactly. The market struggles to value a company that does two very different things. By splitting, they are letting investors choose. Do you want the steady cash cow auto parts business, or do you want the robotics and automation growth play?
You're giving the industrial side the credit and the capital it deserves.
And we're seeing this trend everywhere. GE did it. 3M is doing it. Companies are realizing that in a world of hyper-specialization, being a massive conglomerate can be a liability. You need to be nimble.
Which brings us to a provocative thought to leave you with. GPC was one of the last great holdouts of that old diversified model.
They were. They survived depressions and recessions because they were diversified. When auto was down, industrial was up.
So as we see them break up, the question is, in an age of specialized AI and robotics, is the era of the general store conglomerate officially dead? Or, by splitting everything into these pure plays, are we actually making the corporate world more fragile?
That is the multi-billion-dollar question, isn't it?
Yeah.
They are removing the shock absorbers right when the road might be getting bumpy. GPC is betting that speed matters more than safety.
We will see if the market agrees in 2027. But for now, GPC is clearing the decks, writing the checks, and getting ready for a new life.
A fascinating transformation.
Absolutely. That's all for this deep dive into the Genuine Parts Company shakeup. Thanks for listening, and we'll catch you on the next one.